Welcome to KNN. KNN is brought to you by Bob Knakal, Chairman of New York Investment Sales at JLL.
Hi, I'm John Hageman, Managing Director at JLL. Welcome to KNN. Today I'm here with Bob Knakal, Chairman of New York Investment Sales, and today we're going to talk about how the different types of product are performing throughout the market. So Bob, with the first quarter numbers behind us, we've done episodes about the dollar volume, number of properties sold, the general statistics in both the Manhattan market and also the outer boroughs. But let's talk about the different product types, multifamily, retail, office, industrial, et cetera. Why don't you talk about what we're seeing in some of those buckets through the first quarter so far?
Yeah, Hags, it's really interesting to see how each product type is really performing very, very differently. Clearly, the sector that is the strongest at the moment in New York is industrial. Unfortunately, industrial, because of zoning, makes up such a small component of the overall market that it doesn't really move the needle that much. Mm-hmm. But if you look at the industrial transactions that are happening, rents are up very significantly. Cap rates are very, very low, near the lowest of any product type. And there seems to be tremendous demand for industrial space in the city. So I wish there was more industrial zoning, manufacturing zoning in the city, so we had more opportunities to create more industrial. But clearly that sector of the market is doing really, really well.
What are some of the other bright spots that we've seen besides industrial?
Yeah, well, multifamily, and it's hard to explain why the demand in multifamily is as strong as it is. The rent law changes in 2019 were a significant blow to the industry. We saw a significant decline in the number of transactions in 2019. Also 2020, that was probably a hybrid combination of COVID and the rent law changes. But it seems like starting about after the first quarter last year, the demand for multifamily has picked up significantly, and that market has changed very dramatically over the past 3 or 4 years.
Bob, why don't you elaborate on some of those changes that we saw?
Yeah, well, I think, Hags, if you look at the market, if you looked at the multifamily market 4 years ago and looked at it today, it's a very, very different horizon. We've seen a number of our clients who for decades only bought property in New York are now buying all over the country. That's probably 80 to 90% of the folks who are active in the New York City multifamily market. Fortunately, they've been replaced by people who are priced out of their local markets around the country and are now coming here to buy apartment buildings for the first time. Mm-hmm. There's also a new crop of young investors that are out raising equity that are aggressively buying. So the demand is still there, which is really amazing given the headwinds and potential good cause eviction, lack of being able to combine units to get a new first rent, those types of things. It seems like the political headwinds in that space are very significant, but it's not deterring investors from looking at the space and really keeping upward pressure on property values in the multifamily sector. So that sector is really, really performing well, and there doesn't seem to be any end in sight for that.
So that's multifamily. Let's talk about land. What have we seen in the development?
Yeah, land, and we've been so active on land lately. That's been a real bright spot for us for the last couple of years. But if you look at what's happening in the land market, it's very, very positive. In 2020, there were 22 development sites sold in Manhattan. That increased to 27 last year. The dollar volume nearly doubled. We went to about 1.3 billion of development site sales last year. The total square footage, buildable square footage sold more than doubled. So the dynamics in that land market are very, very strong right now. And I think that's a very positive sign for the market because land is indicative of what developers believe market conditions will be like 3 or 4 years from today when what they're buying is actually going to be built and come to market. Mm-hmm. So the dynamics within the land market are really, really positive, and there seems to be great traction relative to values. In 2020, all of our transactions were in the low 300s. Then we've got to the high 300s and to the 400s. Now many of our deals are pricing in the 500s, even giving guidance of 600 on some deals. So that's very, very positive within the Manhattan market. And interestingly, the window of opportunity to build rental housing in Manhattan was a very, very short window. There were probably 6, 7, 8 months in 2020 when developers were only looking at building residential rental, but everyone's looking at doing condo today. But the dynamics within the market are really great.
So how is 421A affecting now land, now that we've seen that it's set to expire, very shortly in less than 60 days?
Well, a lot of people are talking about that, and I think the impact is much more significant in the outer boroughs because there's more land that's suitable for residential rental. In Manhattan, because of that lack of land being priced for residential rental and everyone willing to do condos in Manhattan, it really is not having that much of an impact. But in the outer boroughs today, if someone has a site that's suitable for residential rental, we're telling them not to put it on the market unless they've done something to get that footing in the ground to vest the site in the Affordable New York program. So the current legislative session ends on June 2nd. There's a ton of things on the agenda. Not sure that they're going to get to a new tax abatement program. We'll see. We hope they do, but very likely they won't. I think last time when 421A expired, it was about 18 months before Affordable New York came back. So, we might be in for a little bit of an air bubble in the pipeline, which will have both a negative and positive effect. Negative in that there won't be land trades for residential rental. There'll be an air bubble in the supply, but then coming out of that, when we get the new program, which most people feel we will get something at some point in the future, that will bode very well for the dynamics within the rental market when a program gets reinstituted.
So we've talked about multi-industrial land. Let's talk about retail and office.
Okay, retail and office are the two sectors where there's the most uncertainty. In the retail sector, the number of retail transactions is down fairly significantly. And I think the retail market's still trying to find its footing. A lot of vacancies. Fortunately, a lot of those vacancies getting rented. But we'll see where the pricing settles out. And in the office market, it's really a tale of two different parts of the market. It seems like brand new office construction is doing really well regardless of the location. Triple digit rents are obtainable in a new office building just about anywhere in the city. And that's very, very positive. On the other side of the coin, you have secondary and tertiary buildings that are struggling to find tenants today. So we're looking at a lot of the smaller B and C and D office buildings. We're looking at possible conversion to other uses. And so that's something that I think will occur because the demand currently doesn't seem to be there to support not nearly the rents that we had pre-COVID. And now we need to come out of this work from home experiment and see what's going to happen to aggregate demand. We're reading about a lot of leases being signed in the city, which is positive, but if you see a tenant signed a 100,000 square foot lease, that could be good, could be bad. If they came out of 50,000 feet, that's great. If they came out of 200,000 feet, that's not so great. So we need to see what absorption is going to look like moving forward. But it really is interesting to see how new construction office is doing so incredibly well versus the rest of the stock.